Darrell Cronk is with us, Wells Fargo Wealth and Investment Management CIO here on set. It's good to see you, D. Welcome.
Thank you.
To Sarah's point, I mean, 3-month annualized core is above the year-on-year.
Yes.
Are we in a trouble spot?
I don't know that we're in a trouble spot, but I think Sarah's got the right point, which is it's not about the December cut, which is in the books and going to happen next week.
But why?
Right? Well,
couldn't that be a mistake?
It could be a mistake down the road because I think what the Fed's still thinking is we've got to bring terminal rates down. Policy is still restrictive, right? And we're above neutral rate. And so they want to keep walking that down.
But where's restrictive? How do we know we're above restrictive?
Well, I think you've got to be somewhere around 4% on a policy rate before, and most of the street would argue 3.5. I mean, when we roll our outlook out, we find ourselves, as we get ready to turn the calendar, out of consensus almost across the board. So we're higher on GDP growth. We're 2.5 versus the street at 2. We're higher on inflation for next year by almost a full point. We're 3.3 versus the consensus at 2.4, which means nominal growth is going to be higher, which we know that earnings are in nominal terms, right? So we have our earnings growth number higher than the street is, as the street has walked it back. 275 for the S&P, right? And the street's now down to about 266, 267, and been walking it back. And we think interest rates naturally are going to be higher for longer on the long side of the curve. So our 10-year number's at 475, right, versus a 422 today.
Ending 25.
Ending 25.
At 475.
That's right. And so a lot of people are on the other side of us. So we'll see. We could be the out of consensus idea. But if you get that inflation, to Sarah's point, I mean, we're going to close the fourth quarter down here with 3.3%. If you look at the Atlanta GDP tracker growth, 3.3% growth, steady unemployment, and higher than anticipated inflation, but not materially. The Fed, we think there's one cut next year.
One cut. I was going to say how many?
Yeah.
Streets looking at
December and then one more.
Any idea when? Would that happen
I think it
post tariffs?
I think it's a January, February, time frame where they either skip January, they come February, and then they're basically
and then they
done.
Communicate that we may be done for a while.
Right, which it plays in, Sarah, to your narrative, which is like the Fed doesn't have the ammunition to cut. I mean, if earnings are going to grow 15%, 13 to 15% next year, why would the Fed need to cut? Right? The economy's humming along at 2.5 to 3%. Inflation's, in our opinion, above expectations.
So do you agree that they're just going to cut next week because the market is telling them to cut?
Yeah, I think it's baked in.
It's a little late.
Yeah, it's a little late to change. You didn't get anything out of the jobs report last week. You didn't get anything out of CPI other than bang on consensus, right, which is exactly where it should have been. And I think they're just going to move forward with trying to normalize policy. They view it as a normalization, not a, hey, lights are flashing red and we have to cut.
So implications for sector weights?
So sector weights, you still got to be heavily pro-cyclical, right? Financials, industrials, comm services, full weight on technology. The interesting thing is if you unpack earnings for next year, Carl, take your 13% growth, you've got to get 5-6% of that out of tech. Right? So tech is still well over a third of earnings growth contribution in next year, which means tech has to play. Right? If it doesn't play for some reason, then we're going to be wrong on our earnings estimates.
And I assume you don't go long Russell or Smiths.
I would call a full weight there, but not favorable. We just don't see that environment playing out well. What I do think, and has been well publicized, is the M&A environment lights up next year, right? Because large buys small, and we have multi-year large outperformance of small. Credit spreads are tight, which creates a cheap funding environment. And then you get the deregulation, FTC announcement today, right? More favorable environment. And just some animal spirits picks all that up, which is good for the stock market.